Amazon just released its latest earnings, but the numbers don't tell the full story. Behind the growth, there are signals investors shouldn't ignore. Let's break down what really matters. We are discussing on the FinTalk channel.
If you want to uncover a corporation's actual strategy, you really have to ignore the glossy press releases.
No, absolutely.
Yeah, like ignore the carefully rehearsed television interviews by the CEO, and definitely ignore the social media posts. If you really want to know what a company's building, you need to look at the dry, heavily regulated, bureaucratic cover sheets that they are legally forced to file with the federal government.
Right, the real underlying structural data.
Exactly. So today we are bypassing the flashy headlines on your news feed to decode the raw, unfiltered source of corporate financial news. Our focus for this deep dive is a single, highly specific document. It is Amazon.com Inc.'s SEC Form 8K, which was filed on April 29, 2026.
Which, presents a massive advantage for you, the listener, because by understanding the architecture of these filings, you get the facts before the media machines spin them into a tidy narrative. You actually learn to read the structural metadata of a business.
Right, so this deep dive is going to act as your personal decoder ring. We are taking a document that looks, on the surface, like a completely mundane legal cover sheet, and we are going to extract the strategic secrets hidden right in plain sight. Okay, let's unpack this.
Well, the best place to start is, honestly, with the sheer irony of the document itself.
Yes, I'm so glad you brought that up, because the stated purpose of this specific April 29 filing is to announce Amazon's first quarter 2026 financial results.
Right.
We are talking about billions of dollars in revenue, massive shifts in cloud computing market share, retail profit margins, and yet the actual numbers aren't even on the form we are analyzing.
Nope, not at all.
Well, they are tucked away in an attached exhibit that we are intentionally going to ignore for this.
Yeah, we are looking exclusively at the vehicle delivering the news rather than the news itself, because the vehicle, it tells you exactly how the machine is built.
Let's start with the anatomy of this vehicle then. At the top of the page, in bold capitalized letters, it reads, United States Securities and Exchange Commission, Washington, D.C., 2549.
Very formal.
Right. Below that, Form 8K, current report. And then it cites the foundational authority. It says, filed pursuant to the Securities Exchange Act of 1934. And, I have to push back on the relevance of this whole process.
How so?
Well, we are living in a world of algorithmic, high-frequency trading, right?
Yeah.
And 247 instantaneous global communication. Why does a technological juggernaut in 2026 still need to file a formalized current report under a legislative act passed during the Great Depression?
If we connect this to the bigger picture, that 1934 Act is the precise mechanism that prevents capital markets from devolving into an insider's casino.
Okay, an insider's casino. I like that.
Yeah, before that legislation, corporate information flowed almost entirely through networks of privilege. If you were a connected banker, you got the financial results over a private telephone line.
Wow.
You traded on it, you profited, and then days later, the retail investor finally found out. So the Form 8K is the structural equalizer. It isn't just an announcement. It is a legally binding starting gun.
Meaning it guarantees simultaneous distribution.
Yeah. Yes, exactly. When Amazon uploads this document to the SEC's EDGR database, it ensures that a massive Wall Street hedge fund manager and you, listening to this deep dive right now, have access to the exact same data at the exact same millisecond.
That's incredible when you really think about it.
It is. It establishes a verifiable, unified reality for the market. And because it carries severe legal weight, every single word, every address, every checkbox on this cover page is heavily scrutinized by corporate counsel.
Which brings us to the corporate information block. It lists the company as Amazon.com Inc. It lists their principal executive offices at 410 Terry Avenue North, Seattle, Washington, 981095210. It even lists the phone number, but right next to the Seattle address, it specifies their state of incorporation as Delaware.
Yes. The classic duality of the American megacorporation.
Right. They operate globally. Their executive leadership sits in the Pacific Northwest, but their legal DNA is incubated on the East Coast.
Exactly. And Delaware Incorporation is a strategic choice rooted entirely in legal mechanics. Delaware operates a highly specialized legal venue. It's called the Court of Chancery.
The Court of Chancery.
Right. And they do not use juries for corporate disputes. They use chancellors. These are judges who are foremost experts in corporate law.
Oh, interesting.
Yeah, if you are a trillion-dollar company facing, say, a complex shareholder lawsuit or some massive merger dispute, you do not want your fate decided by a random jury pool who might not, understand the extreme nuances of fiduciary duty.
You want predictability.
Precisely. Delaware provides a massive, well-documented precedent of case law. It minimizes legal variance. So while the physical packages ship from warehouses worldwide, the corporate entity itself is firmly anchored in the predictability of Delaware law.
There's another detail on this first page that provides an unintended moment of comedy, I think.
Oh, the checkbox.
Yes. Down towards the bottom, there's a prompt asking the registrant to indicate by checkmark whether they are an emerging growth company. And Amazon, a company that fundamentally reshaped global commerce, simply left the little box completely blank.
Just a quiet, legally mandated confirmation that they are no longer an emerging startup.
Right. Like, nope, we're good.
Yeah, the SEC rulebook applies to everyone equally, from a newly public biotech firm right up to an e-commerce behemoth. But to truly grasp the scale of the entity filling out this form, we need to examine the next section.
The list of securities registered on the NASDAQ Stock Market, LLC.
Exactly.
This section is a revelation. First, they list the expected equity, title of class, common stock, par value $1.01 per share, trading under the symbol AMZN. Let me pause there for a second.
Sure.
Par value of 1 cent per share. The actual stock trades for orders of magnitude more than that. Why 1 cent?
Well, it is largely an archaic accounting mechanism, honestly. Historically, stocks were physical paper certificates, right? And they legally could not be sold by the company for less than their par value.
Okay, so it was a baseline.
Exactly. So setting it at a fraction of a cent ensures the market price never dips below that legal threshold, which avoids complex accounting liabilities. It's a relic, but a required one.
Fascinating. But the truly crazy part comes right after the common stock. The document lists their registered debt, their bonds, and it details a staggering 8 different types of notes.
Quite the list.
I'm going to track the timeline on these because the progression is incredible. They start with 2 types of debt due in 2 years. So floating rate notes due 2028 and a fixed 2.800% note also due in 2028.
Notice the dual approach for that first maturity date.
Right, they are hedging. If interest rates spike over those 2 years, the investor holding the floating rate is protected, but Amazon is also locked in cheap capital with the fixed 2.8% note.
Exactly.
But it's the rest of the list that catches my attention. The rates climb steadily as the timeline extends. 3.100% notes due 2030, then 3.350% due 2032. It breaks the 4% mark with 4.050% notes due 2039, then 4.450% due 2045, and finally a 4.850% note due 2064.
That is the anchor of the strategy right there.
Here's where it gets really interesting. I look at that last entry, 2064. This filing is from April 2026.
Yeah.
That is 38 years in the future. I have to challenge the logic here. Amazon generates an almost unfathomable amount of free cash flow from its retail and cloud computing divisions. Why on earth would a cash-rich entities borrow money, commit to paying nearly 5% interest on it, and intentionally push the repayment out nearly 4 decades? Are they secretly strapped for cash?
No, definitely not broke. What's fascinating here is that you are looking at the perfect anatomical specimen of a corporate debt maturity ladder.
A debt maturity ladder.
Yes. And the reason a cash-rich company uses one comes down to the mechanics of opportunity costs and leverage.
Just walk through those mechanics.
Sure. If Amazon uses its own massive cash reserves to build out, let's say, a $10 billion network of new AI data centers, that cash is immobilized.
It's locked up.
Exactly. It is trapped in concrete, in servers, in cooling systems. They no longer have that liquidity available if a sudden economic downturn hits, or, if a prime acquisition target suddenly becomes available at a steep discount. Cash on hand provides strategic agility.
So they use other people's money to build the data centers, preserving their own war chest.
Exactly.
But they still have to pay that 4.850% interest.
Which is incredibly cheap capital for a highly profitable operation. Think about the leverage involved here. If they take $1 billion of borrowed money, costing them 4.85% annually, and they invest it into an Amazon Web Services expansion that historically generates like a 15% or 20% return on capital.
Oh, I see. The spread between the cost of the debt and the return on the investment is pure leveraged profit. They pocket the difference without ever touching their own bank account.
Yes. And the reason it is structured as a ladder with staggered dates, 2028, 2030, 2032, all the way to 2064, is entirely about liquidity management.
How so?
Well, if all that debt matured on the exact same day in 2035, the company would face a massive multi-billion-dollar cash crunch.
Right.
By spreading the maturity dates across a multi-decade timeline, they create a manageable conveyor belt of debt. Every few years, a small tranche comes due. They either pay it off from their massive cash flows, or they simply issue new bonds to refinance it, pushing the obligation further down the road.
It's an engine of perpetual financial motion. But wait, if the timeline extends 38 years, you have to convince an investor to lock up their capital for that entire duration.
You do.
I mean, through potential global recessions, technological paradigm shifts, massive inflation cycle.
Which is exactly why the interest rate steps up as the timeline lengthens. The investor demands what's called a term premium.
A term premium.
Right. They are taking on significantly more unknown risk lending money until 2064 than they are lending until 2028. So they require that higher 4.850% yield just to justify tying up that capital.
That makes a lot of sense. But the investor also has to actually believe the company will still exist to pay them back. Like to sell a 2064 bond, you have to continually prove your immediate financial health. You have to prove you are a safe bet today.
Which brings us perfectly to the core operational update within this specific 8K, how Amazon proves that health to the market.
Right. Because as we navigate past the cover sheet data, we hit the section dictating the actual financial announcement. Under item 2.02, titled Results of Operations and Financial Condition, the document formally announces the Q1 2026 financial results. But the structural delivery of those results is split. Under item 9.01, Financial Statements and Exhibits, the filing lists two highly distinct documents.
Right, Exhibit 99.1 and Exhibit 99.2.
Exactly. Exhibit 99.1 is straightforward. It's the press release dated April 29, 2026, announcing Amazon.com, Inc.'s first quarter 2026 financial results. That's the document the financial journalists will immediately quote.
The highlight reel.
All right, the glossy brochure. But Exhibit 99.2 is titled Information Regarding Non-GAAP Financial Measures. Now, we know GAAP stands for Generally Accepted Accounting Principles.
Yeah, the universal standard.
It's the standardized, rigid rulebook. I want to try an analogy here to understand why a company needs a separate non-GAAP exhibit.
Go ahead, I'd love to hear it.
So is GAAP versus non-GAAP similar to, like, evaluating an Olympic sprinter? Let's say GAAP is the raw, unedited race footage. It shows their exact finish time on the stopwatch.
Okay.
But what if, during that specific race, the sprinter tripped over a piece of debris on the track? Their official GAAP time would be terrible. It's accurate to the stopwatch, but it doesn't really reflect their actual underlying athletic ability.
I see where you're going with this.
So non-GAAP is the coach showing you a modified time. They subtract the delay caused by the debris, and they argue, look, if you want to know their true baseline speed, ignore that one-time accident. Is that accurate?
That captures the mechanics perfectly, actually. GAAP is vital because it creates a universal standard. It ensures that when you compare the net income of Amazon, Apple, and Microsoft, the underlying accounting math is absolutely identical.
Right, you need that baseline.
You do. However, rigid rules often distort the actual economic reality of a specific quarter.
Give me a concrete corporate equivalent of tripping over debris.
Okay, suppose Amazon decides to write off a massive multi-billion-dollar investment in a failed logistics startup during Q1 of 2026.
Ouch.
Right. Under GAAP, they must record that massive loss immediately, taking a huge bite out of their quarterly earnings.
Which makes their e-commerce and cloud businesses look artificially weak for those 3 months.
Exactly, even if those divisions crushed it.
Yeah.
So management uses Exhibit 99.2 to present their non-GAAP measures. They explicitly state, here are our legally mandated GAAP numbers, but if you strip out the one-time write-off from that failed startup investment, here is the underlying operating profit of our core business.
Oh, I see.
They're trying to remove the anomaly to reveal the baseline performance of the economic engine.
But that implies a massive vulnerability. I mean, if management gets to choose what counts as an anomaly, They could easily manipulate the narrative.
Oh, absolutely.
They could take recurring operational expenses like regular employee severance or routine warehouse closures and constantly classify them as one-time restructuring costs just to make their non-GAAP profit look vastly superior to their official GAAP profit.
And that exact manipulation is why regulators scrutinize non-GAAP exhibits relentlessly. Companies have a very strong incentive to treat bad news as a one-time anomaly and good news as core operations.
Of course they do.
To combat this, the SEC enforces strict reconciliation rules.
Meaning the coach has to show the exact mathematical formula used to adjust the sprinter's time.
Yes, Amazon cannot just publish an optimistic non-GAAP profit margin and leave it at that. In Exhibit 99.2, they must present a clear mathematical bridge connecting their preferred non-GAAP figures back to the official audited GAAP figures.
They have to show their work.
Exactly. They must explicitly quantify every single adjustment, every write-off, and every exclusion. The mechanism forces complete transparency regarding exactly how the narrative was edited.
Which underscores the severe legal reality anchoring this entire disclosure. At the very bottom of the document, on the signature page, there is a formal declaration. It reads, "Pursuant to the requirements of the Securities Exchange Act of 1934, the registrant has duly caused this report to be signed on its behalf by the undersigned hereunto duly authorized."
It's a heavy sentence.
It is. And it is physically signed by Brian T. Olsavsky, Senior Vice President and Chief Financial Officer, dated April 29, 2026.
That signature is arguably the most critical component of the entire 8K.
I want to examine the actual weight of that. In a modern corporate environment, we are surrounded by automated approvals, right? PR departments routinely draft and distribute financial press releases to thousands of journalists with a single click.
All the time.
Does a CFO formally signing this SEC document actually alter the legal dynamic of the information being released? Does it make it different from just firing off a PR email?
This raises an important question regarding the fundamental difference between marketing and liability. The dynamic shifts entirely. When the CFO affixes their signature to a Form 8K, they trigger the full enforcement mechanisms of federal securities law.
So it ceases to be a mere press release.
It becomes a certified legal instrument. If a PR department issues an email that heavily exaggerates user growth, the company might face reputational damage or maybe a civil lawsuit.
Right.
But when a chief financial officer signs an 8K that incorporates a press release, as Exhibit 99.1 does here are, they are legally certifying the material accuracy of that information. If they knowingly sign a filing containing fraudulent accounting, manipulated non-GAAP reconciliations, or deliberately omitted material facts, the CFO is committing a federal crime.
Wow. They are attaching personal criminal liability to the corporate data.
Yes. It is the ultimate skin in the game. It places the CFO's personal wealth, their professional license, and their physical freedom on the line.
That's intense.
It is, but this mechanism of individual accountability is what sustains the entire architecture of trust in the capital markets.
And that trust circles back to the debt ladder we discussed earlier.
Exactly. Without that certified transparency, without a legally binding framework ensuring the numbers reflect reality, no institutional investor would ever commit capital to a 4.850% note that doesn't mature until 2064.
Okay, let's unpack everything we've uncovered. So what does this all mean? We began this deep dive looking at what seemed to be the most sterile, bureaucratic page imaginable, right? The cover sheet of an SEC Form 8K filed on April 29, 2026, a document announcing Q1 financial results without actually containing a single revenue figure.
A mere table of contents.
Right, but by reading the structural metadata, we decoded the actual mechanics of corporate strategy. We examined how a law from 1934 still serves as the foundational starting gun for global algorithmic trading, ensuring equal access to information. We explored the strategic necessity of Delaware incorporation to minimize legal variance. We reverse-engineered a multi-decade corporate debt ladder, really understanding how an entity uses opportunity cost and staggered maturity dates to leverage cheap capital while preserving its own massive cash reserves.
And we also dissected the narrative tension between standardized GAAP accounting and customized non-GAAP storytelling, revealing how companies strip out noise to highlight their core economic engine.
Exactly. And we anchored all of it in the legal reality of the CFO's signature, transforming a corporate press release into an instrument of federal liability. You, the listener, now possess the analytical tools to do this yourself.
Highly recommend it.
The next time a major public company makes headlines, You don't need to rely on the sanitized PR summary. You can pull the actual 8K. You can check the debt maturity dates. You can analyze the non-GAAP reconciliation tables. You can bypass the narrative and examine the architecture directly.
And as you begin to read these filings for yourself, I want to leave you with one final structural implication to consider. Think back to the very top rung of that debt ladder. The 4.850% note maturing in 2064. That is 38 years from the date of the filing. Consider the sheer audacity of an investor locking up capital for nearly 4 decades with a single technological entity.
It requires an unbelievable assumption of permanence.
It really does. When that debt finally entity known as Amazon even look like?
Will it even be recognizable?
Right. Will it still be delivering physical goods in cardboard boxes? Or will the core business have fundamentally mutated into an autonomous logistics grid, an artificial general intelligence infrastructure provider, or a global healthcare monopoly?
Or something else entirely?
Exactly. And more importantly, who are the institutional investors holding that paper? By purchasing that 2064 bond, they aren't merely analyzing a Q1 2026 balance sheet. They are placing a multi-decade philosophical bet on the survival, adaptation, and sustained dominance of a single corporate structure in a world characterized by relentless technological disruption.
That is an incredible lens through which to view a simple corporate bond. It transforms a financial instrument into a long-term wager on human commerce. Thank you so much for joining us on this deep dive.
Keep questioning the headlines and always read the structural metadata.